Hello, ladies and gentlemen. My name is Greg Michalowski. I'm Chief Currency Analyst for FXDD. It is August 29, 2012, and this is a special FX Street webinar brought to you by the people of FX Street. Thank you very much to FX Street for allowing this to happen. My email address is greg@fxdd.com. My Twitter is gregmikefx. I also contribute on a regular basis to www.forexlive.com. Before we get started, let me remind everybody that trading foreign exchange is risky, that you can and will or possibly lose, hopefully not will, lose part of your capital or all your capital. So be careful. These webinars that I certainly give, and I'm sure the people, other presenters at FX Street, are meant to help you, to educate you, to mentor you. I don't tend to give you any buy, sell, or hold recommendations here today. Here just to educate you into the dynamics of the foreign exchange market. Hopefully take a look at some levels and some charts and get to some bias. But anyway, let's get started. Title of today's webinar is Bring It On. And I chose that title, why? Because we're ending the summer months. Thank goodness. Labor Day is just around the corner. The UK already had their Monday holiday this past week, I guess. We have, it traditionally is during the summer months, Europe goes on vacation. We've seen the central bankers more quiet. We've also seen a lot of Europeans go on vacation. They typically take, a month off or so. I don't know I never get that type of time off. Nevertheless, people are taking summer vacation. So what does that mean? That means that the larger players in the market are not around. And in a foreign exchange market, it's important for retail traders to understand that it takes those larger players in the market to move the market. They're the ones who take a balanced market. All you retail traders going back and forth, buying and selling, with scalping the market here and there. But it takes the larger traders with all the zeros at the end of the accounts to move the market, to take a balanced market and turn it into an imbalanced market. And what does an imbalanced market mean? It means that buyers are overwhelming sellers. Sellers are overwhelming buyers. It means a trending market. It also means hopefully larger trading ranges. It means movement in the market outside of a range. Basically, that's what we're looking for. That's what we look for at the end of the summer when everyone comes back and the market starts to move. So my comment to the market is, bring it on. I'm tired and sick and tired of these ranges that we've been having here of late, and I want to see the market move. I want to see the market extend, perhaps. I want to see the market trend, perhaps. I want to see the market, get hooked on a feeling, if you will, get hooked on an idea, whether it's dollar buying, dollar selling. And quite frankly, when the market non-trends or stays in a very narrow trading range, it's saying that the market does not, the market, that is all the traders combined, don't really know what to do. They don't know if the euro is going to go down through the 120 level. Really, I have 121.31 as a key level for the euro. Or is it going to continue the move to the upside, going through 126, 127? 128. There's some people, Morgan Stanley, I just read, I think, thinks the euro is going to head up to 135 by the end of the year. Dollar's going to get sold off. So there is a division of opinions out there, and one of them I think is going to take charge. We're going to see a move to the upside or to the downside. So it's a good time right now, August 29th, to take a look at where we are in relation to the past, where we are in relation to some technical tools that we have, kind of just take a step back and understand where we sit at the moment. And so this first chart, which you've been staring at here while I go through my soliloquy here, is the average daily range in pips in 2012 and 2011. And I want to start. I'm starting off with sort of big, and then kind of working down to small, and we'll get to some charts at the end. But what we have here is this is the average of the daily range of each day. So, for the euro versus US dollar, let's go down to this one right here. We have this red line. This represents the average range that we had on a daily basis for all of 2011. And this is the average range for the sterling. This is the average range for the yen. This is the average range for the Swiss, the average range for the Canadian dollars, the average range for the Aussie dollar, so on and so forth, all the way down. Even have some cross pairs in here. And by the way, if you want this PowerPoint, you can just send me an email at greg@fxdd.com. greg@fxdd.com. Put it in there right now. So, and I'll send you off the PowerPoint. Now, the range for 2012, this is the average for the number of days that we've had trading days we had in 2012, is represented by the green bars. And in each of the pairs here, even the cross pairs, the average range in 2012 is well below the average range of 2000. Not well for all of them. Like the dollar yen, had a pretty miserable 68 pip trading range per average in 2011. It's only 60 pips, so it's nearly equal. But most of the other ones, look at the numbers. Look at the numbers. It gives you an idea of how the volatility is down this year. How the volatility so far through August into September is down. So what does that mean? That means that, volatility is down. What is it, and what happens when volatility is down, when the market is less volatile? Well, those people who look for volatility or trade volatility will often look to buy volatility, look for a move away, look for increased volatility when the market is non-volatile or less volatile than previous. And this is a pretty good move. We had 157 pips, now we're down to 116 pips in the euro versus US dollar, 140 pips, 170, nearly 33 pips difference in the pound sterling on average. 14 plus 17, 31 pips in the dollar Swiss. That's of course influenced by, almost similar to the euro versus US dollar. Seeing 25 pip difference in the dollar versus Canada. We've seen 33 pips in the Aussie dollar, which most people think is one of the more trending of currency pairs. We've seen a 25 pip in the New Zealand versus dollar, and so on and so forth. So now we start off with the basis. Okay, well the volatility is down. Maybe in the next 3 to 4 months, it takes us to the end of the year, we'll see an increase in the volatility. I don't think we're going to get up to 157. We've already gone through 8 months of the trading year. Trying to make up that average through the last 4 months is unlikely, but we could see a pickup in the average volume. And if we get to a 125, that means we're going to probably average about 135, 140, I would guess, on average for the rest of the year. Maybe that happens. I don't know. That's just the basis of an argument. Now let's take a look at another chart, and this takes a look at the high range for the year on a daily basis. So what was the maximum range that we had on any single day? Takes a look at the average range. So this is our 116. This goes back to 116 right here. Okay, so this is the average, and this is the low trading range. And this compares to 2011. And we can see in 2011, just take a look at the euro versus US dollar, the maximum trading range we had was 388. In 2012, it's 273. The average is 160 versus 157, and the low is 41 versus 47. So our low is about equal here, but the maximum is still, we could still see. This gives you an idea. What this chart tells me is it gives me an idea of, all right, what type of range could we expect on any single day? If the volatility is going to increase on a single day, if we're going to see a trend market a trend either to the upside or the downside. So what is versus yen? We had $397 Swiss. We had some intervention that caused this huge move right here. It kind of skewed the chart a little bit. But you can get an idea of, okay, where, what can we expect? Look at the pound sterling, 254 versus 266. So we know that around 250 pip move in the pound sterling, if the market starts to trend, would give you some idea about, or a range that you can expect that, okay, if we go above 150, we go to 200. This thing can go to 250. So, it allows you to stay on a trend just to have an understanding of how the ranges lead. But you can see that most of the volatility from a high at least range is down, and that kind of goes with the average range as well. We're going to have less volatility, so we're going to have less numbers in this range. So now let's take a look at 2012 as a year, or let's look at the year ranges. Let's go back and take a look at from 2000 to 2012, and take a look at the high to low trading ranges for each of the major currency pairs against the dollar, and compare them to what our range is for this year. Just to get an idea of how do we stand as far as the low to high trading range in comparison to the last 12 or 13 years of trading, going back to 2000. I guess that would be 13, inclusive, I guess. So what we have here is, let's take a look at the euro versus US dollar. The low to high trading range this year is 1,445 pips. That's the low to high trading range. The average trading range over the last 13, or let's say 12, because I didn't include this year's trading range in this average, is 2,197 pips. So just off that number, 1,400, 2,197, if we're going to have an average range this year, not necessarily suggesting it, but if we're going to have an average range, we've got a ways to go, like 700 pips. Now, is that possible? Probably not. But do we have room to go further? Yeah, I think so. Now, let's take a look at the low, however. The low, however, is 1242. We've already done 1445. So if we, what I know here from this chart at least is that the range that we have this year is already over the low range that we had from 2000 to 2012. All right? So that that says to me that, well, we could stay in this range and still be above the low, but it's probably, we're still well below here. We're just a little bit above what was the low range, but we've got more room to go here. And you can look at the other currency pairs as well, and basically see the same or similar information. Now, actually not. Let's take a look at the sterling as an example. The range for the sterling is 1,069 this year. The average range is 2,572. The low range going back to 2000, and you can look at that and say that the low range is 1418. So we are well below what has been the low over the last 13 trading years. And so that is suggesting that the pound sterling, if it's going to, unless it's going to be a record year by 400 pips, probably has a chance to extend the range this year. That's going to be important when we go to look at the charts. Same goes true for the dollar yen, 817 versus a low range of about 1,000. So we have about 20 pips to go in the dollar versus yen, an extension above or below what the low or high of the range is. Dollar Swiss, that's a special currency pair. Dollar Canada, 647 pips versus a low of 866. That may have potential to move. So these currency pairs, dollar Canada, dollar yen, sterling versus US dollar, they're at record low ranges. And so that might suggest that these currency pairs have the potential to, be winners going forward. Now let's take a look at each of the currency pairs and their yearly ranges going back in time. Remember in that last chart we said the lowest range for the euro was 1,242 pips. That came in 2001. Now let's take a look at this year's at 1445 and compare it to all the other ranges over the last 13 years. And so our 1,445 pips is actually the second lowest trading range on record. 1565 would be the third, and above that would be, I guess, 1905. So although the range is more than the lowest range, it's still comparatively very low. In fact, you can say that we have, if we're going to extend, we have about 120 pips to get just above that next level. So the next lowest level. So if this is an aberration, and this is maybe the second aberration, or this is a second aberration, are we going to move more toward the mean? Do we have the possibility to move more toward the mean? And again, this we don't know. But what we know is that the range is narrow. Range is narrow relative to prior years. So when the range is narrow, I'm going to start to think in terms of potentially extending the range, either to the upside or to the downside. Take a look at the sterling versus U.S. dollar, and you compare the ranges going over time as well, and you can see that this range is indeed the smallest range going back, over this going back to the year 2000. And we had a 6,000 pip range at one time. The average somewhere around in here probably, or the mean, I guess, somewhere in here around the 1800 or 19. So there's plenty of room for the sterling. Dollar versus yen. Again, lowest trading range on record going back to 2000. Potential for this market to move higher. Last year was the second lowest at 996. So we're moving in this direction to the downside. Can't get any lower than this. Perhaps we move higher. Dollar versus Canada. Very low trading range in relation to historical numbers right here. Aussie versus U.S. dollar. Lower than the last, going back 1, 2, 3, 4, 5, 6, last 6. This is the lowest range of the last 6 years. 6 trading years. Did have some lower ranges in this period right here, which suggests that it's possible that we've hit the max for the Aussie versus U.S. dollar, but there's still potential in relation to the current history to have a range extension. New Zealand versus U.S. dollar, like similar to the Aussie versus U.S. dollar, narrow trading range over time. Now let's take a look, kind of dig down even further. We've kind of looked at a historical perspective of each of these currency pairs and said, all right, there's possibility that these ranges are very narrow and we have the potential to extend. Now let's take a look at the summer, okay? I mentioned that we've been in this summer period here where the ranges have been, somewhat narrow, somewhat in at least some of the currency pairs. And so what I wanted to do is take a 3-month range, a running 3-month range of the different currency pairs, and then compare that from a historical basis to see, okay, well, has this last 3 months been a low volatility range type period? In which case, if it is, what we know is that low volatility can lead to high volatility, so we can start to anticipate perhaps a breakout and move away, and that anticipation will allow us to be prepared for potentially a trend type move, and that's most important in your trading as a trader. So let's take a look at this 3-month range for the euro versus US dollar. And again, this is a running. So what I do is I take the range for August, July, and June, and take the high, take the low, or take the high and take. I take the high and take the low over June, July, and August, and I calculate the number of pips in that range. So over the last 3 months, we've had a 706 pip range for the euro over that 3-month period. Take the high and take the low, and that's 706 pips. Now, looking back to 2010, you can see the number of different points that we've had on this. I just went back to January 2010. But you can see that the last 3 months has been one of the lowest month ranges for the euro versus U.S. dollar. We did have a lower 3-month period in the earlier this year for this currency pair, and that went down to 513. But I would expect, looking at this report, that that all systems are go for a September move, for the range to extend. That for the non-trending period that we've had over the last 3 months, over the summer period, to start to move to a trending period. And some people say, well, it's a summer month, so you expect that. Well, no, if you expected, if every summer period was a low trading month, we'd see the same low as low of trading period going back in time. And you can see, let's say we go back in this period right here, the range for the euro over that 3-month period in the summer of, I guess, 2010 was 1,486 pips. Let's go back to this period right here. Well, it's about 858, maybe 900, 971, 1,001. We only had 706 pips here. So we have this this potential for the move to extend. That's what this chart says to me. That's what the volatility says. Sterling versus U.S. dollar, 644 pips. Going back to 2010, this is the most narrow trading range over a 3-month running period that we've seen. So again, this suggests to me that we have the potential to extend. Dollar versus yen, we've had the range over the last 3 months has been the same for this currency pair. In other words, we've had an inside trading month this month, so it didn't change any of the numbers here. So this compares to 286. Again, going back to 2010, the running rate is low as well. So suggests that the market has certainly the potential to move away in this currency pair as well. Dollar versus Canada. Although the range that we saw is narrow for the dollar versus Canada on a yearly basis, the range for the last 3 months has actually been fairly robust, if you will, or at least off the lows and near almost the mid probably of the range, 3-month ranges for this currency pair. So it's kind of a weird pair in that we have a low to high trading range suggesting that either the trend has started for this currency pair and we have the potential, we're seeing the trend start in this 3-month period, and that we could have further room to go in that currency pair. Same with the Aussie versus U.S. dollar, had a fairly good trading range over the last 3 months. New Zealand versus U.S. dollar as well. So I guess the purpose of all these graphs kind of to get to the point where we can say, what do we know? We know that the range for the year is very narrow from a historical perspective. What do we know as well? We know that the range over the summer has been fairly narrow as well. So what else do we know? We know, from at least from some of the currency pairs, the range for the summer has been more narrow than historical standpoints. So that says to me, bring on September. And I know it was kind of a long way to get around that, get to that idea. But perhaps, for me at least, I like to see, where we stand. How do we stand in relation to historical years, historical periods, for currency pairs individually? Where do we stand in that? And by knowing that, you're able to have a better grasp of where are we going. The word anticipation in trading is, I think, one of the more important words that you as a trader can start to think about. If a trader is able to anticipate something that may happen, they are able to take advantage and remain with that trend type move if it starts to happen. What do I mean by that? Well, if you expect the range to start to extend because the range has been narrow and the market starts to break, what a lot of retail traders do is they get out of that trend break too early. They see the break, they take advantage of the break, but they don't let it ride. They don't let the market perhaps get to their target levels where it wants to go, where it has the potential to go. So understanding and anticipating a potential break is important in trading. And we know that it's, coming to the end of the summer, and maybe I could have said the same thing by just saying, well, it's in the summer and September comes along, we always have the potential, September things start to cook up again, so look for the break. But from a historical standpoint, I think I've shown that there are some currency pairs here today that that we look at here today that perhaps suggest there's more room to go, or there's better opportunities in some of the currency pairs. So let me let's go and take a look at some of these charts and see what they're saying. See what they're saying as far as bias. See what they're saying as far as direction. See where we potentially may be going. And I'm sure I'm not going to get through all of them. But do you see my euro-dollar chart up here right now? It's the monthly chart of the euro. Took the camera off, put it back on. Yeah. Okay. Good. All right. Now, let's start off by taking a look at the. I'm going to take this off right here. There we go. The euro versus U.S. dollar. And what I'm going to put in here is a Fibonacci retracement. And I'll just analyze this market from a technical perspective to get an idea of where, what the charts are telling us, because the price and the tools applied to the price help traders get a bias for the market. And if the buyers are overwhelming the sellers, the price goes up. If the sellers are overwhelming the buyers, the price goes down. And so for me as a trader, if I'm looking for a movement away, I want to know the key levels that we're dealing with, the key levels that are going to say this price has the potential to move further and further in the direction. So I put a Fibonacci retracement from the low to the high right here, and I want you to note this 121.31 level here. This 121.31 level is the midpoint of the euro-dollar's lifetime range. Highs, lows, trends, reversals, overbought, oversold, all call from past observations. Yeah, but tools applied to them, and tools that can be applied to them give you a bias as far as the market goes. So let me. I'm sorry if I'm not getting to the questions as they come in or the comments, but let's try to stay or just try to stay on focus here. This, by the way, is a 100-month moving average, and this is a 200-month moving average. Now, I must warn you that the euro hasn't been in existence for 200 months. So what this line represents is a derived euro-dollar price from I think it's done off the basket of currencies. So if you took the basket of currencies and applied the formula to it, you could have figured out a synthetic euro-dollar price. And so this 200, and that may be right or wrong. So I'm a little bit skeptical, or a little bit cautious about the 200-month moving average. Although you can see here what the market did at that price, it found support on this year. The market low came in at 120.41, and the 200-month moving average 120.62. So not bad, but then 21 pips of the 200-month moving average price went a little bit below and moved back above it. Now, but what's more important, what it is known is that this is in fact a low for the euro versus U.S. dollar, and it's in fact the high for the euro versus US dollar since its inception. So what we see here is that in the 50% retracement of that low to high trading range comes in at 121.31. Now I'm going to put my cursor over here on or at the well, you can't see it, but what the low that we've had for the month of August came in at 121.33. So we hit a low. We hit the 50% retracement at 121.31. Really printed 33 as the low, and the market bounced off that. You can see that on the daily chart. The low here came in at 121.31, or actually the low here for the month of August. This is the beginning month of August, and this is on the second trading day of the month. The market low came in at that level. And what have we done? The market took that as a clue that the price that there was support. There were support buyers against that 121.31 level, midpoint of the euro versus US dollar. Consider it a key level. And so the market did what it was supposed to do. Now, what do we have on the? So the market has moved higher in this month of August. Moved up, and this is August, this is July, this is June. Moved up toward the upper end, if you will, of the August trading range. This is a high. This is a high for the last 3 months. Now, we are at a key point here for the euro versus US dollar as we head into the month of September in a few days. That key point is right here, right at this point right here. What level is that? Well, the blue line represents my 100-day moving average. 100-day moving average calculated off the closing price of 5 p.m. New York time. That's the standard 100-day moving average closing, or that's the closing price for the any currency. Well, not every currency, but most currency pairs. So that level currently comes in at 125.93. The 38.2% retracement of the 2012 trading range. This is our high for 2012. It occurred on February 29th. The 38.2% comes in at 125.92.6. So 125.93.4, 100-day moving average. 38.2% retracement, 125.92.6. 1 pip is the difference between both of those two key technical levels. Technical levels that I feel lots and lots of traders are paying attention to. So, ironically, or not, maybe not ironically, the market has moved toward this equilibrium level. This level where the market has a decision to make. Go higher or go lower. And I feel that in over the course of the next few weeks, that the market has the potential to make that decision. We have a lot going on in Europe. We have over the next couple of weeks. We have, as usual, I mean, they're coming back from vacation, and they're also going to have, we're going to have ECB meetings and such stuff like that. We have the U.S. interest rate meeting toward the beginning of September as well, where the Fed is going to decide whether they do QE3 or not. We're going to have unemployment coming out, a key unemployment next week in the U.S. What does that do? Does it keep the momentum going? We're going to have, we're having right now the Republican National Convention. We're going to have, I don't know when the Republican, I assume the Democratic National Convention is in the next few weeks as well. I don't really know for sure. I should have probably checked that, but that's also going to come into play. So things are lining up, aren't they, for, some energy. And energy from a technical energy develops from a fundamental perspective, and also it can develop from a technical perspective. And I feel that the technicals are more important than the fundamentals more important for a trader, because they define your risk. They limit your risk. Fundamentals can change. They can go back and they can go back and forth. They can focus on one thing. They focus on another thing, but you cannot define risk with fundamental analysis. You can't say my risk is here because of off of Italian yields or off of Bernanke QE3 or something like that. You cannot define your risk off a fundamental piece of news, but you can define your risk against a technical level. And this level right here, my friends, 38.2% 100-day moving average, is going to be a key, I think, going to be a key level going forward. So be aware, be prepared. And so what do you do after, or what do you do at this level? Or you use the level to lean against. If the market breaks above, look for momentum to develop. Look for the price to stay above that that key level. Look for the market to put some energy away from this level. Look for the market to break up toward our highs here, above this trend line, to the 50% retracement, to the 200-bar moving average. If it were to go from here to here, this would be 273 pips extension to the upside. That would make our range over the last 3 months 822 pips. That's possible. That can happen. And if you go back to our charts of the euro versus US dollar, you can't see it now, but I'll tell you that that if we had a 3-month trading range that extended up 825 pips, that still is a low 3-month trading range from a historical standpoint going back to 2010. That apart from the 513 that we had earlier in the year, the prior low trading range going back to 2010, 3 months, was 858. So a move from here to here that brings the 3 months trading range up to 825 is doable and is actually still keeps a narrow trading range for the pair. A narrow trading range for the 3-month period for the pair from a historical standpoint, going back, on a 3-month rolling rate going back to 2010. And by the way, it can extend, 2007 was really a more narrow trading range. I didn't just stop at 2010 because it makes the data look good, and I can send you the data, probably, or make the chart larger for you. I just stopped it at that point. But the point is that the range is narrow now. It's probably the most narrow trading range since 2007, and we're at a key level here. So I'm gonna start being prepared for a move either to the upside or the downside. Now, what happens if so that's the break to the upside and the run to the upside. Don't be surprised if we don't see the 200-day moving average, if the euro doesn't get up to 128.65. It could happen. Knowing that it could happen from a perspective of relativity is important for you to understand. So don't discount it. Now, what happens if the price breaks above this level, comes up to this topside trend line, which is the high here, comes up to the 50% retracement and kind of works its way, comes up to this resistance level, finds resistance against this level, and starts to come back down? Well, you as a trader can, it's a simple moving average. You as a trader can use these levels to lean against the other way, because what could happen? We could see the market come up to this level right here, break back below this key level here, and go down and make new lows and continue on down through the 121.31 level, 50% trading range of the euro. That's going to be our key level on the downside, folks. Break through that level. Look for momentum to take this back down to the 118.76, 2010 low for the year. So look for that range extension to the downside. But this is going to be a key level. So if the market goes up, comes up to our resistance level right here, and then rotates back down, we're going to be using this 38.2, the 100-bar moving average, as our level to move the other way. Move, what was a key resistance level on the top side becomes key support on the downside and key borderline for the market to move the other way. So as I see it right now, and what happens if this 38.2 and the 100-day moving average starts to hold? Well, folks, here's where we're going. We have to break through this trend line. What's the importance of this trend line? 1, 2, 3, 4, 5, 6. We bottomed at this level that started this move to the upside. That's kind of why I'm focusing on this upside a little bit here. I know the trend's down here, but we had 1, 2, 3, 4, 5 market found buyers, moved up, just found some resistance as it should at this level right here. Now, if we cannot get through this 38.2 and stay above this 38.2 and this 100-bar moving average over into the early parts of September, through the, we're going to know by a week now, a week and 2 days. We're going to know it. Then I would look for the market to rotate back down and break through this trend line here. The trend line is going to come in somewhere around the 124.08. Is going to open the door for the downside, and we should see some further momentum to the downside. So those become my targets. Watch the trend line. Watch the 100. Watch the 38.2. Watch the old high, the 50%. This top side trend line, which is just a parallel trend line off of here. Market likes to stay in channels when it trends often, and look, a break of that is going to look for the 200-bar moving averages topside trend line. Have your lines in place. Know where you're going. Be aware. Be prepared. Anticipate. The best traders are anticipate. Let's take a look at the sterling versus U.S. dollar. We said that the range for the sterling versus U.S. dollar is one of the most narrow trading ranges that we've seen all over going back to 2000. All right, it's a pretty long time period for the year. What have we done here? We're looking at the daily chart here, and we can look back over time here. We've been in a consolidating trading range here. Probably put a trend line across here. Maybe if you want, you can do something like a trend line there. High, tested the high. Matter of fact, I like that trend line right there. When you have 1, 2, 3 different points on a trend line, makes sense, right? 1, 2 creates a trend line. 3 confirms that trend line. Confirms that the market's paying attention to this level. That's what you want to know. The market, when you see a technical level stop on a trend line, it says they know it exists. Now, what was also at this level? The 100-day moving average. And this trend line came across here. And what did the market do when the market broke above this trend line? Moved higher. Where did we go? We went to the 61.8% retracement of the move to the downside. Did we correct? Yes, we corrected. Where do we find support? Yesterday against the 100-day moving average. Moved off of that level and this trend line, by the way. And let's count the points on this trend line. 1, 2, 3, 4, 5. Went a little bit below it yesterday, but ran right into our support against the 100-day moving average and quickly bounced off of that level. So what is a pound? What is a cable? Pound versus U.S. dollar telling us? Telling us bullish. It's telling us stay above this trend line, stay above this 100-bar moving average, stay out of this non-trending trading range right here, or the solid sideways non-trending trading range that has been gripping the market up and down, up and down, up and down for the last 3 months. Stay above it, and it's bullish. What else can you deduce from that? Nothing. You cannot say that it's bearish at this moment. you have to say we're above that, we're above the trend line, we're above the moving average, we're above the trend line, we just tested the trend line, we just tested the moving average, we're in a non-trending trading range, we broke above that level, and we dipped a little bit below it yesterday, back into it yesterday, but the market found the buyers, closed above it, and moved higher here today. So have that as your basis. Or will this market continue to go higher? I don't know. To be honest, I don't know. But what I do know is that risk is defined by this line. I know risk is defined here, risk is defined here. If the market should go below this line, then it takes some of the bullishness away from this market. If the market breaks below the 100-bar moving average, it's probably over, and the market's probably going to head right back down to the downside. Where would we go on the downside? Break through the 200, go through the 38 point, start back into this range, come down to this trend line, which has 1, 2, 3, 4 different points on it, and we'll see what happens there. If it breaks through there, it's going to go through this trend line, go to our low, through our low here, and head down through that 150 level. That's how I see it. Those are the steps along the way. Those are the technical steps that not only I can see, but everyone else can see. It doesn't take much to draw a trend line, does it? Doesn't take much to connect lows. Doesn't take much to connect lows here. Although we only have 2 lows here, we'll see what happens if the market comes down. Also put in Fibonacci retracements and test the downside. What about the upside? The upside is a little more difficult because if you look back in history here on this daily chart, the market was in a free fall here. Down day, down day, down day, a little correction, down day. We came down fast and furious, mainly from this high right here. So there's little in the way of key levels, and we're above the 61.8 as well. You can probably put in the 75 or whatever retracement level, but you start to go back and look at different levels over time. These are what I call remembered lines, okay? And so I just put in a line here. You see this bar right here. This bar has a high that comes in at 160.60. 61 actually. So that's about as close as I can get. 160.61. What did the market do here? 160.61. Well, we broke above it, failed, broke above it, moved higher, came down, tested, and moved to our highs. When the market came down, we came back down to that 160.61 level. The market found support, moved higher. Found support, moved higher, dipped a little bit below, and kind of did the opposite right here. Dipped a little bit below it, dipped a little bit above it, and then moved down below it. Started its move to the downside. So that's where I think we would, the next major stop for the sterling versus U.S. dollar is 160.61. We can head up to that level and move in that direction. So that would be my target on the top side. On the top side, of course, we've got to get through the 61.8% retracement. That would open the door in this high right here. That would open the door for this move to the upside. Another clue that you can do, that's off the daily chart right there. One of the things that you can also do is maybe put up an hourly chart. Let's go back to the daily. This area right here came in around May 16th. So go to an hourly chart. This is our 61.8% retracement, and you can see, you can see what happened or why we went up to the 16. Let's go back to the daily. Let's go back to the daily. 159.05. Okay, that's where that level is. Now let's come over here and take a look at the hourly chart. Here's our 61.8%. And you can see why the market found some resistance at the 61.8. It also was support on this day right here on the hourly chart. And traders will, when you see a trend, when there's nothing much to grab onto, they'll go back in time and they'll start to look at, what were the key levels even on an hourly chart back then. What was this? What about this point right here? Why did it do that? Why did it spike up to that level? And they may grab something like that. So that's what I'd look for right Perhaps an interim level would be around the 159.85. Part of trading, folks, is not only knowing what the bias is, but defining your targets along the way. Where are we going with this? What are the levels? Because that defines, get above one, where are we going? Well, we're going up to this 159. Oh, look at this level corresponds 159.85. Remember, we were looking at that spike high around this area right here. That also corresponds with this high right here and this high right here and close to this high right here. So the fact that this level right here on the hourly chart corresponds with this level means the market knew about that. It knew about that level. So keep that line in your chart, folks. If the market should break to the upside and continue its directional bias to the upside, expect 159.05, 159.85. All right, let's just take a look at the dollar versus yen, and then we'll end it there. Dollar versus yen over the last, over this year. What do we do? What do we do against our key levels here? Well, let's take a look at the top side here in this month. Where do we stop this rally for the month? Right against the 100-day moving average. Right against that 100-day moving average at the 79.62 level, the high came in at 79.65. Do you think the market knew that 100-day moving average was there? Or do you think just it randomly stopped at that level? Just like it did in the euro, just like it moved above in this pound sterling and tested it yesterday. No, the market knows these levels exist. It's going to trade against it. So is the 100-day moving average important? Yes. Is the 200-day moving average important? Yes, because of coming together. 100 and 200-day moving average coming together, it's a kiss in the middle. That's called non-trending. That's called three's a crowd. I call it three's a crowd when the two moving averages and the price come together, and it may be that we're heading that way, then the market tends to move away from it. So just like the euro, just like the pound sterling, we're near key levels. This is only 79.26. This is 79.40. In September, if come next Friday, we get a strong employment number, the market moves to the dollar yen starts to move up as a result of it, or something happens. I don't know what's going to happen, and it goes through the 100 and 200 bar moving average. I would expect the last time it tested the 100, look, went above it, failed it, came back down, boom. So over the last 3 months, the market's tested the 100 bar moving average twice, and twice it's failed. If it moves above it, what are we going to do? 80.14. 80.91, 81.67. Those will be our targets along the way. How does this compare from a historic, from a, well, I don't do that, weekly chart. This is a weekly chart, and I know we have these lines in here that's kind of messing it up, but look where we've come from the dollar versus yen. Look where we are right here in this non-trending range. If it breaks above the 100-day moving average, well, let me get rid of these lines. Do I have? Oh, here, I'll put this up. Boom, 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 boom. Get rid of this. All right, good. Look at this from a historical standpoint. This is a weekly chart. We've only been above the 100-week moving average 4 or 5 weeks. On this correction at the beginning of the, well, I guess this is March of this year, and we've been holding below the 100-week moving average. Brings another point. 80 is where that comes in. Break above 80, folks. We're going to be back above that 100-week moving average. Only 4 or 5 weeks, or 3 or 4 weeks here. We've been above it since this point, going all the way back to 2007. Is that going to be significant? Do we have room to roam on a break above it? Yeah, I mean there's clearly possibility of room to go. So on your daily chart, we know the 100-week moving average now is at 80 level. So I'm going to put a horizontal line in my chart against the 80 level, right there. Next stop to the 80.14. That's if we get above this level. Now, what do we have on the downside? We have support. Let's zoom in here. support, 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 support. We've tested support a number of different times. Couldn't get down to the support line here this week or last week and a half. So if the market should break below the 78.15 level, all bets off. The market's going down. All right, I would say this is a key level, and I expect the market to get below this line, and start its way down toward this level right here. That's what I would expect. So we're at a key level now for the dollar versus yen. All right, let me see here. Let's see. So that kind of takes us to the end here. I don't want to go beat a dead horse here with a summary. I think you guys all get it. But September is kind of shaping up to a key point. We have some key technical levels. Maybe you saw some, or maybe you can add some to your charts here going into September. Be aware, be prepared, take advantage of them. Look for a move, and we'll see what happens. Bring on QE3, QE4, QE5. We'll see the end result of that. Yep, we're gonna, we'll see. QE3, dollar gets weaker, 128 in the euro, not out of the question. All right. You look at my three currencies to unlock, figure it out, not that hard. This data is from the first half of 2000. Okay, it happened before March 2000. Grant you charts shown relative to the larger period well observed. That was in 2000. Greg is looking for volatility. There's most will agree accrued. Next year I'll learn something and go on holidays most of August. Yep. Yep, we're going to wrap up here. All right. Any key questions here? Why are they remembered? Okay. What is this? What is this? My chart doesn't look like Greg. The chart he is showing. All right. If your charts look different, if your moving averages, the daily moving average looks different, ask your broker two things. What do they use for the close? The time for their close. Some brokers might use Greenwich Mean Time. 100 hours Greenwich Mean Time, not the true end of day close. Some brokers will also have closing prices on Saturday and Sunday. If they have closing prices on Saturday and Sunday, that is not standard practice. My moving averages at FXDD correspond with Bloomberg's and what is standard practice in the market. So I don't know what the solution is. Like some people were saying, 124.85 was the 100-day moving average yesterday in the euro because they had a Saturday and Sunday closing price. Market doesn't trade on Saturday and Sunday. If ask your broker about that. Tell them, or come to FXDD. Open an account with FXDD. Moving average period simple 100 bar moving average. All right. That may be the difference in the daily chart. But, folks, if you're trading off of a chart that has a closing price on a Saturday and Sunday, your day moving averages are going to be wrong in compared to the market. Sorry to say, but that's the industry standard, and I want to be along with the industry standard. The other thing is make sure that their closing price is from 5 p.m. New York time. That's when the spot date changes from one to the other. Again, that can have an effect on your charts, on your moving averages, and you could be trading off of levels that no one's really paying attention except you and the other retail traders at Owanda or wherever they're trading. Thank you very much. Thank you to the people at FX Street. Thank you for everyone else for coming in here today, and I hope you enjoyed it, and good fortune with your trading. My name is Greg Michalowski. I'm the Chief Currency Analyst for FXDD. Good fortune with your trading. Let's get September going on. Bring it on.